Dunnigan, I've been systematically buying physical gold since 1999. I don't need to buy more gold. I'm going to buy more gold, but the fact is I own lots relative to what I might need. Other people are less fortunate. Most of the American public, if pressed, probably couldn't spell gold. And I think they need to begin the process of systematic acquisition of gold, unless they have some other internal inflation hedge that works for them. In fact, with regards to my own circumstance, a good financial planner would look at my estate, being the largest shareholder of Sprott, and say, why do you own gold at all? If the gold price does well, the businesses that you own will prosper, and you'll win by proxy. I own gold because it's insurance. It helps me sleep nights and stay calm. Sleep is a good attribute if you're 71 years of age. So everybody's circumstance is different. For people who have their lives structured in a way that persistent inflation will be ugly for them. People with long bond portfolios, people relying on conventional pensions, particularly defined benefit pensions. I think they need to begin the process of the systematic acquisition of assets that are traditional inflation hedges, and they need to do it now. If the price of those assets falls, God bless. If I'm wrong, then your conventional pension will do a good job for you. But I would ask those people to consider the probabilities of what I've said. Judge their actions accordingly. I have found myself, if you look at the whole of my net worth, the whole of my portfolio, I've found myself adding cash. It is not a deliberate strategy. I'm not trying to get liquid. I am already too liquid. What's happening is that some of my speculative bets and some of my investments have paid off. They've gotten to the point where they're no longer cheap, so I sell them, and I haven't been able to redeploy the money. It was interesting. I'm not trying to liken myself to Warren Buffett, but I listened to Buffett's discussion the other day about the cash holdings of Berkshire Hathaway exceeding $300 billion. And what he said is, I'm finding myself opportunity constrained. He isn't suggesting that the market's going to collapse. He is suggesting that when he looks to buy businesses in the size and of the quality that attracts him, that there aren't very many opportunities. At the same time, some of the existing businesses that he owns in a large measure, Apple as an example, Bank of America as an example, are at this price, relative to the earnings stream he sees them generating over the next 5 to 10 years, less attractive. He hasn't been a seller from a strategic point of view. He's been a seller from a tactical point of view. And I find myself in the same circumstance, albeit, sadly, with a couple zeros missing.
For Rule, gold is not just an investment, it's insurance. He began systematically accumulating physical gold in 1999, a decision that has paid off handsomely over the decades. However, he emphasizes that his motivation for buying gold is not about making a profit, but rather about preserving his wealth and ensuring peace of mind. At 71 years old, Rule jokingly notes that sleeping well at night is a valuable commodity in itself. Gold, as he puts it, helps him stay calm amidst financial chaos. Rule's advice is particularly relevant for Americans, many of whom, he quips, probably couldn't spell gold. He stresses that the systematic acquisition of gold should be a priority, especially for those whose financial well-being is tied to long-term assets vulnerable to inflation. For individuals relying on traditional pensions, particularly defined benefit plans, or holding significant long bond portfolios, gold serves as a hedge against the erosion of purchasing power. However, Rule cautions against overinvestment. Owning too much gold can lead to psychological and financial strain during periods of volatility. He recalls the early 1970s when gold surged from $35 an ounce to $200, only to plummet to $100, a dramatic 50% drop. Many investors, unable to stomach the downturn, liquidated their holdings prematurely, missing out on gold's subsequent rally to $850 an ounce. The lesson? Position sizing matters. Gold should form a part of a balanced portfolio, reflecting individual needs and risk tolerance. Rule acknowledges that he finds himself opportunity constrained in today's market, echoing sentiments expressed by Warren Buffett. With cash accumulating from profitable investments, Rule has struggled to find attractive opportunities to redeploy his capital. This predicament highlights the broader issue of inflated asset prices across sectors, from equities to real estate. While cash might seem like a safe haven, Rule emphasizes that it's not a long-term solution. Inflation eats away at cash's purchasing power, making it critical to transition into assets that hold their value over time. Gold, with its historical resilience, fits this bill perfectly. Unlike cash, which depreciates as central banks print more money, gold's supply is finite, ensuring its intrinsic value. For investors holding excess cash, Rule's strategy offers a roadmap. Look for assets with strong fundamentals, and when opportunities are scarce, consider increasing exposure to gold as a defensive play. Gold's primary role in Rule's portfolio is as insurance. It's not about chasing speculative gains, but about safeguarding against systemic risks. As Rule points out, if the gold price does well, the businesses that you own will prosper and you'll win by proxy. This insight is crucial for understanding gold's function in a portfolio. Unlike equities, which generate returns based on earnings growth, gold acts as a counterbalance to economic instability and currency devaluation. Rule draws attention to the historical context of gold's performance. From 2000 to 2010, gold prices surged from $253 an ounce to $1,750, delivering a seven-fold return. During the 1970s, gold's move from $35 to $850 represents an eight-fold increase. These numbers underscore gold's potential to protect and grow wealth during periods of economic turbulence. For Rule, the ultimate value of gold lies in its ability to withstand inflation. He cites the IRS's own data from the 1970s, which shows that the US dollar lost 75% of its purchasing power during that decade. Investing in gold requires not just financial capital, but also psychological stamina. Rule emphasizes that investors must assess their risk tolerance and position size accordingly. Overexposure to gold can lead to panic selling during downturns, as seen in the 1970s when many brave gold bugs capitulated at the first sign of trouble. Rule's advice is simple but profound. A little bit goes a long way. Gold's historical price movements suggest that even a modest allocation can provide significant upside during inflationary periods. For investors new to precious metals, starting small and building a position over time can mitigate the emotional strain of market volatility. History is a powerful teacher, and gold's track record speaks for itself. Rule's anecdote about the 1970s highlights how gold thrives during economic upheaval. The collapse of the Bretton Woods system in 1971, which decoupled the dollar from gold, unleashed a decade of stagflation that saw gold's price skyrocket. This period serves as a reminder that gold performs best when confidence in fiat currencies erodes. Fast forward to today, and the parallels are striking. The global economy is grappling with unprecedented debt levels, central banks are resorting to aggressive monetary policies, and inflation is creeping higher. In this environment, gold's role as a safe haven is more relevant than ever.
I will say, too, that too many people who buy our narrative overinvest in precious metals. They invest so much of their net worth in precious metals that they can't stand the periodic price declines that occur in precious metals. I remember very well in the decade of the 70s, in the period I'm guessing 1970 to 1974, early 1975, the gold price had advanced from an admittedly price-controlled $35 an ounce up to $200 an ounce. And of course, all the gold bugs were geniuses, Then the Fed raised the interest rate, and the gold price fell by half. The gold price fell from $200 to $100. It was a 9-month wipeout. And all those brave gold bugs, not all, but most, or at least many, turned tail and ran. What happened was, when the price action didn't justify the narrative in the short term, people's faith vanished, and there were wholesale liquidations of gold. The people who did liquidate, the people who didn't have the financial or psychological wherewithal to stay the trade, missed a move in the gold price from $100 an ounce to $850 an ounce. The point is that your holdings of precious metals or precious metals equities need to reflect, A, your needs, but B, your psychological and financial stamina. If you are overinvested in the space, you are likely to get shaken out. The second thing that people need to understand in terms of position sizing around precious metals is that if you own them for insurance, a little bit goes a long way. If you look back to the decade of the 70s, Forget about $35 an ounce to $850 an ounce. Let's assume that the move from $35 an ounce to $100 an ounce was recovery of ground that was lost during the period where the gold price was controlled. So let's just say at the beginning of the period that the free market price of gold should have been 100, and it went to 850. That's an eightfold move in the gold price. Fast forward to the decade 2000 to 2010. The gold price moved from $253 an ounce to $1,750. What's that, a sevenfold gain? I'm not suggesting that gold is going to move sevenfold or eightfold in the next 10 years. All I'm suggesting is that gold historically has had really substantial upside, much better upside than people who don't read history have any sense of. You know, when people today are excited about the fact that gold's 2,700, and I've said this on your show, I don't own gold because I think it might go from 2,700 to 3,000. I own it because I'm afraid it's going to go to 9,000 or 10,000 or some higher number. I don't know what a sevenfold increase from $2,700. I don't know what that number is. And I'm not saying it's going to go there, but I'm not saying it's not either. It seems to me the only way out of our fiscal and political impasse is to reduce the net present value of the promises that we've made to each other. The time-honored way to do that is inflation. The IRS, not some cranky old libertarian, suggested in the decade of the 70s the U.S. dollar lost 75% of its purchasing power. If that were to occur in the next 10 years, it's anybody's guess where the gold price might go. People also need to understand I might be wrong. You don't want to have a larger investment in precious metals than corresponds with your financial and psychological ability to take risk. A little bit goes a long way, but get that little bit.
Rick Rule's conviction in gold is not built on a whim, but on a lifetime of observing its behavior during economic upheavals. Gold, as he reiterates, is not merely an asset. It is a form of insurance, a financial lifeboat in a sea of monetary uncertainty. For Rule, the intrinsic value of gold lies in its ability to withstand systemic risks, from inflation and currency devaluation to geopolitical instability. One of the most compelling aspects of gold is its universal appeal. It transcends borders, cultures, and political systems. In a world where trust in fiat currencies is eroding, gold offers something that paper money cannot: permanence. This is why central banks, particularly in countries like China and Russia, have been amassing gold reserves at record levels. They understand that gold is not just a relic of the past, but a cornerstone of financial sovereignty in the future. The 1970s offer a powerful historical case study for gold investors. During this tumultuous decade, the collapse of the Bretton Woods system unleashed a wave of inflation that decimated the purchasing power of the US dollar. Gold, freed from its fixed price of $35 an ounce, surged to $850 by the end of the decade. This eightfold increase wasn't just a financial anomaly, it was a stark reminder of gold's ability to act as a counterbalance in times of economic distress. Yet, as Rule points out, the journey was not without turbulence. After reaching $200 an ounce in the early 1970s, gold experienced a sharp correction, falling to $100. Many investors, unable to endure the volatility, sold their holdings at a loss. Those who remained patient, however, reaped extraordinary rewards as gold soared in the years that followed. The lesson here is twofold. First, gold's long-term potential is immense, but second, it requires psychological and financial resilience. Investors must be prepared for periods of volatility and resist the temptation to sell during downturns. Investing in gold is as much about managing emotions as it is about managing money. Rule emphasizes the importance of psychological stamina, particularly during times of market turbulence. Overexposure to gold can lead to panic selling, as seen during the 1970s correction. To avoid this, investors must align their gold allocation with their risk tolerance and financial goals. A little bit goes a long way, Rule often says. This advice is especially relevant for those new to precious metals. Gold's historical performance suggests that even a modest allocation can provide significant protection against inflation and economic instability. For example, a 5% allocation to gold during the 2008 financial crisis would have substantially offset losses in equities and bonds. While gold often steals the spotlight, Rule is quick to highlight the unique attributes of silver. As both a store of value and an industrial metal, silver offers a dual benefit that makes it an attractive addition to any portfolio. Its lower price point compared to gold also makes it more accessible to a broader range of investors. Silver's industrial applications, from electronics to renewable energy, add another layer of demand that sets it apart from gold. As the global push for green energy accelerates, silver's role in technologies like solar panels and electric vehicles is expected to grow, creating a strong tailwind for prices. For investors, combining gold and silver in a portfolio offers diversification within the precious metal space. Gold provides stability and acts as a hedge against systemic risks, while silver adds growth potential and exposure to industrial demand. Rule's current position as opportunity-constrained underscores a broader issue facing investors today: the challenge of finding value in a market characterized by inflated asset prices. While holding cash might seem like a safe strategy, Rule warns that cash is far from risk-free. Inflation erodes its purchasing power, making it imperative to transition into assets that can retain value over time. This is where gold and silver come into play. Unlike cash, which can be printed at will by central banks, the supply of gold and silver is finite. This scarcity ensures that their value remains intact, even as fiat currencies lose credibility. For Rule, holding precious metals is a way to preserve purchasing power while waiting for better investment opportunities to emerge. Rule's observations about fiscal policy and its impact on gold prices are particularly insightful. The sheer scale of government debt and unfunded liabilities has created a scenario where inflation is not just a possibility, but a necessity. By inflating the currency, governments can reduce the real value of their obligations, effectively transferring wealth from savers to debtors. This dynamic makes gold an indispensable asset for those looking to protect their wealth. Unlike fiat currencies, which are subject to devaluation, gold's value is intrinsic. It cannot be manipulated by central banks or undermined by political decisions, making it a reliable hedge against fiscal irresponsibility. Rule's strategy of systematic acquisition is a practical approach for investors looking to build a position in gold and silver. By purchasing small amounts regularly, investors can mitigate the impact of price volatility and avoid the emotional pitfalls of market timing. This disciplined approach also allows investors to take advantage of lower prices during corrections, ultimately reducing their average cost per ounce. For those new to precious metals, Rule's advice is clear: start small, but start now. Even a modest allocation to gold and silver can provide significant protection against inflation and economic uncertainty. The key is to view these assets not as speculative investments, but as foundational elements of a resilient portfolio. Rule's insights extend beyond individual investment strategies to the broader implications of a gold-centric financial system. Central banks, particularly in emerging markets, are increasingly turning to gold as a way to diversify their reserves and reduce dependence on the US dollar. This trend underscores gold's enduring relevance as a global store of value. The rise of BRICS and other initiatives aimed at de-dollarizing the global financial system further highlight the strategic importance of gold. For countries like China and Russia, accumulating gold is not just about safeguarding wealth, it's about asserting financial sovereignty in a multipolar world. Rick Rule's philosophy on gold and silver offers a roadmap for navigating an increasingly uncertain financial landscape. His emphasis on systematic acquisition, psychological resilience, and historical perspective provides valuable lessons for investors of all levels. In a world of rising inflation, fiscal irresponsibility, and geopolitical instability, gold and silver stand out as beacons of stability. For those willing to embrace a long-term perspective, the rewards can be substantial. As Rule often says, a little bit goes a long way. By starting small and building a position over time, investors can protect their wealth and position themselves for success in an ever-changing economic environment. The time to act is now. Whether you're a seasoned investor or new to precious metals, the lessons of Rick Rule are clear. Gold and silver are not just assets, they are lifelines in a sea of financial uncertainty. By incorporating these timeless metals into your portfolio, you can ensure that you're prepared for whatever the future may hold.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.